Okay, so in my last video, we talked about the 5 absolute basics to getting into commercial real estate. The first one of those was to get a job in commercial real estate. That's the easiest way to learn. Check out this video here where I talk about how to get a job in the industry. If you've been trying to break in, you probably know how difficult it can actually be to find a job. So we give you some tips there and also some different jobs that you could look into. But number 2 on that list was underwriting commercial real estate, learning how to properly financially analyze a deal. So today I'm going to break down what underwriting is, why it's important, and how to go about doing it for your next project. So underwriting comes from the Latin term. Just kidding, we don't care about any of that. We're just going to talk about what it is. Underwriting is a financial analysis of a property. You look at all of the numbers, break them down from your purchase price and your down payment all the way to how much rent you're collecting every month, what your vacancy rate is, any interest expenses or operating expenses you have on the property. And then you can even break it out into how much you're paying to your investors and how much you're paying to yourself. That's essentially what underwriting takes into account. It's all of the financials within a project. Now, these are of course going to be projections going into it because you don't necessarily know what you're going to collect in 3 years in rent, but you will have historical data, hopefully from the seller, or that you can at least find yourself to say, okay, well, taxes in 2020 were X, and my insurance agent says that insurance on the property is going to be Y. So you can at least get a pretty good idea of what the project is going to return to you. I see a lot of rookies make this mistake. They just jump into a deal and say, oh, well, I'll put, 20% down and we're getting, $2,000 a month in rent and I've got to pay the bank X and this is how much I'm going to make every month. And that's not really true at all. There are a lot of expenses when it comes to operating these properties. So when you look at a deal and say, oh, a 7 cap looks pretty good, you might actually dive into it after financing and after all the operating expenses and you're losing money. But you could also find another project that's a 7 cap where you make a ton of money. It totally depends on the lease structures and all the expenses on the property. So underwriting is very important in commercial real estate because you need to know your numbers backwards and forwards, because not only will the bank expect you to know that, but so will your investors if you're taking any on. And look, we're not here buying buildings for our own health, right? At the end of the day, we are trying to make money. These are investments. You think about the stock market and how many news channels and online resources there are telling you which stocks to buy, which stocks not to buy, why you should invest in this company, what the forecast is going to be for, this corporation and where their stock's going to be in 5 years. You need to do the same thing for your projects. Take them just as seriously as an investment firm does when they're looking at which stocks to buy. Now, you can get incredibly complicated when it comes to underwriting, even taking into account the chances of a big corporation coming to your city and changing the rental rates and what could that look like if you stress test the deal. Now, we don't need to get that complicated in this video today. We're just going to break down what I think every beginner investor should be doing at a minimum, which is your back of napkin numbers. Now, we actually have a spreadsheet for sale on my website where you can actually get a pre-made spreadsheet that has the most common expenses that we see when we're underwriting back of napkin on these deals. You could also throw your own together if you know how to work on Excel. So we just did that to make it a little bit easier on you so that you don't have to spend 30 minutes setting up your own sheet. But if you don't, there it is, available on the website. So this spreadsheet is very basic. Like I said, it's back of napkin. It is intended for us to look at a deal and within 5 to 10 minutes know whether we should be spending 2 weeks underwriting it. Because if you're properly underwriting a deal, it's going to take a long time. Because when you're looking at these bigger commercial deals, you got to talk to contractors and figure out how much it's going to cost to renovate. So, honestly, in that scenario, 2 weeks is not nearly long enough to properly underwrite a deal, and we'll just use projections based off of past experiences. But it can take a long time to actually go through the full underwriting process to create a spreadsheet that you would feel comfortable sharing with your equity investors and with your lender, because your lender is probably going to want to see how you've underwritten the deal and how you've come to the conclusions that you have on the cash flow and the debt service coverage ratio that you'll get. So this spreadsheet takes into account your income. So rent, you could also add in another line if you wanted to add in additional rent. Sometimes you've got a property that maybe you've got a drink machine outside, right? So there would be additional income coming in there that's not necessarily rent that you would probably want to add into your underwriting so that you're taking into account the total amount of money you're collecting every month. After that, we have all of our expenses. So everything from insurance to interest expenses, common area maintenance, property management. We've got utilities, taxes, and then it aggregates everything into your total expenses so that you know, okay, well, every month we're spending approximately X, or we at least need to be budgeting for X every month, because some of your expenses you're not going to pay on a monthly basis, you'll pay them annually. But I always recommend at least just taking that out every month so that you don't really see it too much at the end of the year when you got to write that check. From there, you'll get your net income, your monthly cash flow, and your cash flow before debt service, as well as your debt service coverage ratio. Most banks will want to see that you're at a 1.2 or 1.25 debt service coverage ratio. So that's why we threw those two numbers in here. I don't need to know my cash on cash return at this moment because I don't even know how I'm going to structure the deal with my investors. I need to know if a bank is going to lend on this project first. So in this example that we threw together, it looks like a 1.03 debt service coverage ratio. So obviously I wouldn't even bother underwriting that further because I know for a fact that a bank will not lend on it unless I throw in so much money in equity, which is way more expensive than debt, to get it to a 1.2 or 1.25 debt service coverage ratio that it wouldn't even be worth looking at this deal. So as you can see, our back of napkin underwriting is relatively straightforward. It doesn't need to be all that complex. And you can actually tailor these spreadsheets to show you the exact numbers that you need to see. Maybe you're not really concerned about the debt service coverage ratio because you're not taking out a loan, and the cash on cash return is more important to you because you're paying all cash. That could be your back of napkin metric. Ours, we just go for a debt service coverage ratio because I know that I will be putting debt on the property. After that point, we will then take it into our other underwriting models, which are far more intense. And like I said, they take a long while to actually dive into and fill out all of the numbers. And those are the spreadsheets that we will end up presenting to our equity and to our banks to show them, hey, here's the internal rate of return. Here's why you should give us capital. And here is how secure this is as an investment. So lender, you should give us some money. Now we do have another live stream where I dive even further into the underwriting process using one of my more complex models. Click this video right here if you want to dive into that and learn a little bit more about modeling commercial real estate.